Welcome back to the Phil Bach podcast. My guest today is Rob Simone from Hedgeye. Rob is a managing director and partner at Hedgeye, where he runs their REIT coverage. He's got about 15 years of corporate equity research experience within the REIT sector and 2 years in business development and IR at a REIT. And he has been on this story from day one, this story that we're about to talk about. I can't wait to jump into it. Rob, thank you for joining the podcast.
No, thanks, Phil. Thanks for having me. Good to be here. It's always a pleasure.
So I've got this idea, this thing that I talk about a lot. I spent my first 15 years in finance in the industry, and I never thought about REITs at all. They were just,
Mhm.
this subsector, and I was like, a REIT is a REIT. It's all real estate beta, more or less. Like, how different of it. Well, come to find out over the last 2 years, obviously with Armada, but even ahead of that, one of the things that attracted me to Armada was seeing the correlations between the subsectors, how low they were, how different, the drivers of each of the different subsectors are, the geographies, even like the financials, and seeing all the opportunities within REITs is a whole different perspective that I have now. But I suspect that a lot of the listeners and a lot of the people that, have been following along to this podcast, they also, they think more deeply about markets or entrepreneurship or the economy, probably not too deeply about REITs specifically. So I want
Yeah.
to start here. Like, the story that you're about to tell, it shows like the need for real due diligence, a real exploration of what's happening at these REITs, but it also touches on some other things, and it has some real impact, which we'll talk about hospitals and patient care and other things. It's not only investors that are impacted by this story. So I want to kind of set the table. If you could just start with like, hey, what is a REIT and how does a
Yeah.
hospital get involved, like, with what does a hospital have to do with REITs and this story? Like, what is the connection? And maybe we could start there.
Yeah, of course. No, those are good questions. I mean, put simply, like all a REIT is a tax shelter. And that might sound kind of silly, but a REIT is just a publicly traded corporation that is given special pass-through tax status by the IRS, so long as it meets a number of qualifications. And by the way, that's very, very relevant for this story. And pays 90% of its taxable income to the individual shareholders. The IRS basically says, like, okay, if you meet all those requirements, we'll allow you or give you a pass on your corporate income taxes, and everybody that receives dividends individually gets taxed at the individual level. So in the end, it's just a pass-through entity. It's put simply.
And how does that connect to, let's say, a hospital, like in
Yeah.
this case? Like, well, what's the connection? I just want to start there before we
Yeah,
start
sure.
jumping into.
Yeah, totally. It's so, well, I mean, REITs do a lot of different things, right? So like one of the things that's interesting about the sector is that I think there's a perception that maybe like it's a little boring, or REITs are a little boring. That couldn't be further from the truth. They actually, touch so many different parts of our lives, right? So like they're segmented by different subsectors, whether it be, apartments, logistics, office, retail, et cetera, up to and including healthcare. And the way that, well, first of all, outside of this one example, and by the way, that this company is called Medical Properties Trust, or ticker MPW, Michael Peter Walter. MPW is the only triple net lessor of hospitals. And what does that mean? Basically, a triple net lease is a type of lease. There are a couple different types of leases. And what this company does is it basically buys the real estate, so like the physical buildings of a physical hospital building, mostly acute care hospitals, and then typically does what's called the sale leaseback, and leases the property back to the operator. So if it's what's kind of referred to in the industry as a propco opco. So propco being the REIT, opco being the operator, and the reason why it's set up that way, there are two types of REITs that cannot run or manage the business. So like if you, like, for example, if Phil, if you were to like go lease an Avalon Bay apartment, Avalon Bay, which is a big apartment REIT, has a captive management company. They turn and refurbish the units, they manage the ground, they upkeep the property, et cetera, et cetera. There are two types of REITs that cannot do that, where they and specifically their lodging and healthcare REITs. And the reason why is they fall outside of the gross income test under REIT rules. So you have to, as a REIT, you have to basically have a minimum amount of your revenue, your gross income, be in the form of rent. So like think about what hotels do, for example, right? Like you go to a resort, you pay your rent, which is just your room rate, but then there's all this other stuff, right? There's F&B, there are resort services and all that stuff. So like the hotel falls outside of that gross income test. Similarly, a seniors housing building or a hospital, et cetera, there are all these other revenue sources that don't meet the qualification of rent. And the IRS says, okay, you REIT, you can own that building, which is what MPW does, but you have to hire a third party to run it for you. And so that's how it kind of comes together.
I think it's important to establish that because, when we talk about, rents of an Amazon warehouse or, even apartment complexes or whatever it is, um, a hospital is a special thing. I mean,
Yeah.
there are communities that rely on hospitals, and when you treat a hospital building and when you treat, the real estate that a hospital uses as a cash cow, then it's got implications that go, well beyond the investment community, well beyond the REIT itself.
Yeah.
The numbers, there are people that depend on that hospital being there, that when they call 911, they have a place to go to get care. And I want to kind of set the table with that and establish that up front, that we're not just talking about FFO and AFFO and
Yes,
numbers on a
for sure.
spreadsheet. Like, this is real life implications. So, with that kind of stated up front, like, you're a REIT analyst, right? What was the first inclination? What was the first time
Oh,
you were like, well, something smells a
yeah.
little funny here?
Yeah, I've told this story a couple different times. And by the way, you're right. Like so one of the, we kind of live in many cases in the confines or the prison of our jobs. So not prison's the wrong word, but like in the like the prison of the function of our jobs, and we think about everything numbers wise, and we tend not to like think about the implications outside of it. And one of the things that like has really resonated with me through this process is just like the human toll that has happened here. And I think it's really important not to lose sight of that. But I think that will be, made clear through the story. But basically back in 2022, so it's crazy, coincidentally, it's about 2 years now, which is like nuts. It's been like the last 2 years of my life trying to understand the story as best as possible. Um, there was a series of Wall Street Journal articles, the third of which actually dropped in February of 22 about this company, Medical Properties Trust. And truth be told, at that time, I wasn't even aware of that. What happened was I was kind of talking with investors about another short idea we had. And by the way, Hedgeye doesn't run or manage money. We provide research services as a third party advisor. And so I was talking with my clients about another short idea, and a couple of them over the course of like I would say four of them over the course of 2 or 3 weeks asked me, "Hey, have you taken a look at MPW? Do you think they're going to have to cut their dividend?" And the first two, my answer was no at the time because I hadn't spent any time on the name, and I didn't want to like kind of speak out of turn. But then like the third and fourth time, I was like, oh, okay, there's something going on here. So like I got to understand this. So on a Friday night, Friday, I printed out a bunch of stuff that analysts typically use to analyze REITs. So, a couple call reports, most recent 10Q, the 10K, and importantly, the proxy statement. And Phil, you and I may have talked about this, but like I'm a big believer in the proxy statement being like arguably one of the most important documents in the REIT world, or if not everywhere. And really quick, all a proxy is for your listeners, it's a filing with the SEC that every company, REITs or otherwise, that are publicly traded have to file once a year. That basically like the way I think about it is it's like a roadmap of incentives. It lays out all the different ingredients that help you understand like what makes a company tick behind the scenes, the goals that it sets for itself, how they pay their management team, how the checks and balances work, etc. And so I printed this stuff out. Like I didn't really have any idea what the road I was going down. Went home, kids went to bed, I think on a Saturday night, and I just locked myself in my office and I started reading. And before I knew it, it was like 3 in the morning. I just couldn't stop. And so the first thing that struck me in the proxy statement, and I'll try to like talk about this, not technically, but one of the plan metrics for this company that you never see anymore, right? So like there were a few externally managed REITs that had this function, but essentially, if when you look at the comp plan metrics or the targets, the management team has a dollar volume of acquisition target, and that's a pretty remarkable thing. And what I mean by that is like you're basically paying the management team to like potentially go out and A, buy anything, be an asset aggregator, and B, pay the highest price.
Mhm.
Right. So like no, you don't want your management team to go out and pay the highest price and win every deal. You actually want them to lose some deals because that means that they're being like very disciplined, rational allocators of capital.
Opportunistic, right? If they win everything, it's the
Yeah.
winner's curse. They congratulations, you gave the highest number.
Correct. That's right. And
Yep.
and if you're trying to hit a dollar volume target to meet your comp plan, I mean, listen, not to downplay what anyone does, but like, and I don't have $1 billion, but if you gave me $1 billion tonight, I guarantee you I could buy $1 billion of hospitals tomorrow. All you need is my signature. Now I don't know what the hell I'm doing in doing that, but like that's the point, right? Like if you set that, it sets a really low bar for diligence and sophistication, et cetera. And if it's not moderated the right way, it can like really get out of control. And in my view, when I saw that and I didn't see on the page like a moderating force, I kind of knew already. We say at Hedgeye, like think about where the puck's going, not where it is.
Yep.
You kind of know, okay, this is going to wind up in a bad place potentially. And then the second part, now I'll shut up for a second, but REITs, and this is important for REITs in general, like they're meant to be investors in property, in real property. So you can either buy a building, like the equity of the building, so the actual building itself, or you make a mortgage loan against a building, and collect interest income. So it's like rent or interest income, but either way, you're deriving your returns from the real estate. What this company does is very weird. It buys hospital real estate from what I would call like say essentially safety. And this is kind of the speaks to the first part of our conversation that there's like a real human cost here. I think that MPW is a big adverse selection problem. And what I mean by that is like when you go to HCA or UHS or Tenet or any of these guys, the big like national hospital operators, they'll tell you or they'll kind of allude to, hey, we don't want to lease our real estate. We want to own it. And the reason why is I think they've come to understand over the years that like the model just doesn't work. If you think about a hospital, right? So like hospitals derive their income from insurance reimbursement and reimbursement from Medicare, Medicaid by CMS essentially. So if you have like a high percentage of what's called public pay or public insurance from Medicare, Medicaid, the hospital basically becomes like a regulated utility in a way.
Mhm. Mhm.
So think about like for your listeners, think about and this is my mental framework. So I'm sure some would disagree with this, but like this is kind of like how I think about this world. Think of your gas company or your water company, right? Like it the government allows private capital to come in and run that business and earn a return, but it's been deemed so valuable and so important to society that the government will put a cap on that return and not allow the utility to gouge its customers. So it's like a regulated return business.
Yep.
That's essentially what public pay hospitals are, right? Like CMS sets reimbursement rates, and then you as the operator, you kind of have to like make all your expenses fit underneath that. Otherwise, it blows up.
Okay, so you saw a few things that, maybe smelled a
Yeah.
little smoke, but you didn't have, I mean, there was no smoking gun. There was nothing that was,
Oh,
shouting outright fraud, right? I mean, there's a few things here.
well, Yeah, so that well, the this is related to that. Like what I'm saying is, MPW self-selects in a way for the hospital operators that are least financially not sophisticated, but like the least well capitalized companies that need capital.
Right.
Because the ones
Okay.
who don't, yeah.
So,
And
yeah.
and then what they do is they do these sale leasebacks, but then when the lease is, this is where like it could be fraud. Like I personally think it could be fraud, and it's very perverse. When the operator starts running into trouble under the weight of these leases, rather than cut the leases, they loan the operator money.
Okay.
That's like very problematic, right? So anyway,
And that's where steward comes in. So it's the weekend, your kids are sleeping, you got to be up in a few hours, you're staying up all night to read these
yeah.
read proxies. Somewhere else, not too far away, I am trying to fall asleep and I'm reading read proxies in order to fall asleep, but be
Right.
that as it may. So what happens next? So okay, so you find these things, you wrote them up. What happens next?
Yeah, well, the next, I mean, I just kept reading, kept doing my work, did my modeling, did as much diligence as I could, pulled property records, like tried to form a mosaic of what this company has done over its existence with Stewart and which is its biggest tenant, but other operators as well. And in my view, like, the disclosure is terrible. It's gotten like I don't even know if it's gotten better. It's evolved over time. The disclosure is very bad. It's very opaque. I think that's deliberately so. So you have to like really dig in to build a mosaic. And after I kind of like knew or thought I knew like what my thesis was going to be, and this is where look, this is I'll let other people judge. I know how I feel about this, but I'll let other people judge. I did what most of us would do. I reached out to the company and said, to the IR department via email a couple times and said, I think three times, and basically said, like, hey guys, like I'm Rob. I work for Hedgeye. I run the REIT group. I'm doing work on your company. We don't invest money. I'd love to set up a chat with you, yada yada yada. But I also wanted them to know me and to like ask me any questions. So there's not this like REIT Rob guy out in the ether, just like, saying whatever. And no response, no response. It just got to the point where I had to do my work. So at Hedgeye, we do what are called black books. Published my presentation, did my video, sent it to the company, and basically said, hey, like, I want you to get this from me. I don't want you to get it secondhand. This was April 21st of 22.
Mhm.
About a week later was the company's earnings report, and the response was remarkable. It was kind of like unlike anything I've ever experienced in my career. Very standoffish, very agitated, like not really rebutting any of the points from my short thesis, but like kind of pretending they were. But then the CEO said something really interesting. Guy by the name of Ed Aldag. He in his preparedness, so no, again, this is in the prepared remarks of a publicly traded company CEO. At the very end, he said, and I'm kind of paraphrasing here, but just keep in mind all investors out there that not all analysts and market commentators are equal or right objectively without conflicts. And if you guys want to get the truth, come to me, come to the CFO, come to the IR department. So like it was like this ministry of truth approach. And I was actually in my car. I was listening in my car and like I this is a true story. I'm like, I got him. Like I knew right there, right? I was like, this is going to be a process, and like I got to dig in on this because this is not normal. And I clearly hit a nerve, and I know something's wrong here. So that's kind of how it
Here's
got
at
started.
this point in the story, and it's still kind of warming up, but here's what I don't understand. This is a publicly traded REIT. There's analysts all over Wall Street, right?
Mhm.
There's investors of significant size, some of them, and you're asking a couple questions. All of a sudden, they get all defensive and
Mhm.
agitated. Were these questions never asked before? Were other analysts on Wall Street? Has nobody dared to bother to
Yeah,
do this research before?
I can't. I honestly, I don't know if I could answer that because I was never in the room at the time in those meetings. But like, I could tell you what I see, right? So after after the report was released and it kind of made the rounds in the REIT community and with my clients, et cetera. And yeah, like the guys are forwarded back and forth amongst each other. It's what they do. In talking to folks, it's like, yeah, like these are a lot of the concerns that we kind of thought were there. This is from the buy side, not from the analyst community, from guys that are actually investing money. It's like, yeah, like a lot of very valid concerns, some new ones, some things that like we didn't think about before, and it looks like pretty bad. And then on the analyst side, so it's a really interesting question. So, Hedgeye, I think one of our strong suits is that we're independent. So we don't have banking, we don't have trading. All we have are our ideas and our views. And so like we work really hard to try to get those right. Because if we don't get them right, like no one's going to pay for us. Whereas like in a big multi-line investment bank has trading and banking, et cetera. I think that this company over the years, because it, again, thinking back to the comp plan, was so desperate to grow, acquire anything it could, sold a lot of stock, sold a lot of bonds, generated tremendous amounts of fees for the banks, and was like a serial issuer over the years. And so there was like this complacency, but also this like, I mean, you know, imagine like a sell side analyst who might think that there are real problems here. They go out and they blow up one of their bank's biggest corporate clients. Like there's a high bar to doing that. So I guess it's a long-winded way of saying there are real conflicts there that prevent, objectivity. And that's where we try to step in.
So you did, and you found, you found some, you had some questions, right? You raised the questions, and you could tell immediately by their response, that they look
And
guilty
since
as
then,
hell.
by the
So
way, and we could talk about that too. And since.
yeah, well, so what? Yeah, so what happened next?
Yeah, so well, what happened next, and this is Phil, you'll get this, but think about like the calendar. We were a couple weeks away from the June REIT conference, which is a big industry boondoggle in New York every year. And to my understanding, MPW actually like canceled its meetings at that conference. But then what they did was on in July. Now, like that's important because technically every company is in a quiet period. A quiet period is like after the end of a quarter, you're not supposed to talk to analysts or investors about material things or like really at all without filing an 8K and making it public to everyone. Well, what these guys did, they canceled their REIT appearance in June and then individually invited all of the sell-siders down to Birmingham for one-on-one meetings at the corporate headquarters. Now, like that's pretty remarkable. If I can't speak to anyone else, but like if I were in that seat, I wouldn't have gone because that's opening yourself up as an analyst to like potential Reg FD issues. It's very irregular behavior. And let's be honest, it's nothing close. As a matter of fact, it's not even close to best practices. It's like worst practices.
Right.
To me, it kind of, like felt like kind of like a gangster approach. And I say that like somewhat, jovially, but hey, come on over. Like, hey, we'll take you out to dinner. We'll tell you what's really going on. Like, this is what's really happening with the company. And it's just like, it's not what should be happening, right? If that makes sense. So that happened next. And then from there, I mean, like the company reported, then, like we kept doing our work. I was finding all these disparate things. Like Phil probably saw a bunch of it on Twitter. I'm a pretty active Twitter user with this company because I think that like there's value in building a public record. But yeah, like so this is a good one. And this kind of came full circle you know, about a couple weeks ago actually. Phil, you run a company. I have not run a company, but I've like worked inside like in conjunction with the C-suite of a company. One thing that happened really early on that we noticed was that MPW started changing its AFFO definition
Mm-hmm.
gradually, not all at once, but gradually.
AFFO, for people that aren't REIT people that are listening, that is the key metric that people use to value REITs, right?
Mhm.
That's like if you got to go with one number, right? You might go with
Yeah,
cap rate, you go with A. I mean, that's like, it's a key
it's
metric
up
for
there.
REITs. Yeah.
It's up there. Yeah, it's easily a top five. And the reason why this is important is because like you have to think about how many sets of eyes review those definitions and review those documents, right? Like you have the lawyers, you have the IR team, the accountants, the FP&A team, the CFO, the CEO, the audit committee, et cetera. Like things do not change like that except by design. Okay. Now, I observed a gradual, not at all at once, but a gradual change in that definition. So, like, by the way, AFFO is supposed to be cash flow for those who are watching. REITs are kind of, lease accounting and REITs are kind of funky for a bunch of different reasons. Like, depending on what kind of leases you have, the revenue you book on your income statement, and this is like where I come in, like what analysts are supposed to do. There can be a lot of non-cash revenue. And that sounds crazy and like, but that's the way it works, right? Like under lease accounting, there are things called straight line rent and FAS 141 and all these different things that like basically create a spread between what you report as revenue and like what your cash is. And what they basically did in changing the definition is collapse the two. They eliminated some of the non-cash deducts that had been there and made cash flow more closely resembling like what they reporting in their income statement. So the question is why? Right? Like what we're supposed to do is say like, okay, we see this. Why are you doing it? And so we raise those questions. And I think some of my clients probably, or as a matter of fact, I know my clients asked the company like why they did that. And the answer was like, well, yeah, the definition changed, but the reporting's the same. So just like a nonsensical answer. What we found out later was that the number two tenant, Prospect Medical, which is without getting too technical, had these like really crazy deferral amounts. They were booking Prospect's unpaid rent as cash flow in AFFO while Prospect wasn't paying. And that ultimately became the answer. And we caught them red-handed and like kind of, absolutely red-handed in doing this. And like let's be honest, these are big dollars, right? So like we're talking about 15% of earnings, 20% of earnings, enormous amounts of unpaid cash rent that was included in what investors thought was cash flow. So I went through like hours upon hours upon hours of looking at statements, like kind of seeing what made sense and what didn't. And one day I wrote a note on, I'll never forget this, on September 10th. September 12th, I wrote a tweet thread. It's still there. It's actually still pinned to my Twitter. Just detailing the different parts of this. Well, 2 days later, I had a subpoena delivered to my house that was dated September 12th, the same day that I wrote that thread. And nothing ever came of it, and by the way, this subpoena was related to it has to do with a case. They're suing an activist short seller, like a third party firm that is different from Hedgeye. And basically like within the confines of that case, like gave me a subpoena and whatever, but like the date passed to add me to the case. And I'm like, look, like I caught you guys red-handed. This is part of this. This is intimidation, right? Like this is an analyst
Oh, yeah.
doing his job, finding things that like investors should care about in underwriting this company, engaging whether or not you have an honest management team. And rather than, issuing a call for retraction or telling me where I'm wrong or any of the above board things that a company would do. No, 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 no. You send a subpoena to my house. Okay. Like you just told me I'm over the target. You just told me where to look.
But there are people that would be intimidated by that. There are people that would get this. So you know what? This is not worth the trouble. This is
Look,
not
it's
worth it.
scary. It's scary, right?
Right.
Like the first time that happened, like I would be lying to you if I said like, man, that's nuts. Like the first time that happens, it's intimidating. But you know what? Like I was very fortunate to have a very supportive firm in Hedgeye who said, Keith, my boss, and Michael and Daryl, they're like, look, if you think you're right, we'll back you. Just make sure you're right. And so we decided to kind of like stick to our guns, and lo and behold, long story short, This very important document came out that kind of like showed that it was true. And then a week ago, get a load of this, they retroactively admitted all of that non-cash rent was there the whole time. And so now it's like, okay, like you sent me a subpoena over something that I noticed and was right about and something that's material. You ultimately can't kind of quasi came clean without coming clean. Like, I think the world needs to know about this because like that, if in my world, in my career, if I don't see a fraud, if this isn't a fraud, I'll never see a fraud. Let's put it that. I don't know. Like it's for someone else to adjudicate whether or not it's accounting fraud.
If your whole job is to find the fraud and you didn't find it, what are you, a rating agency?
Right? Like, what are you even doing? Like, are it's like, do you even rate, bro? No, like it seriously, like if this is not, if that's not fraud, I'm quite sure. And I don't like, listen, again, my job is to build the body of evidence and to give people the numbers and the tools to make decisions. It's for someone else to decide. But they hid over the course of 2 years almost $360 million of unpaid rent for a company that has rent of 1.2 billion. Now, I I I think that's material. I'm no like I don't know. You tell me. Like that
So
sounds pretty material.
that's pretty material. So 360 million of missing rent. What happened? What was it? Was it all steward? Like, why was the rent not getting paid? And why were they so quick
Yeah.
to cover for and forgive a tenant?
Yeah, well, actually, that's a really good question. I think it related to multiple tenants, but primarily Steward, which is the biggest at about 20 or 20, formerly 25%, but closer to 20 now. And Prospect Medical, which blew up first, that was about 11% of rent. So I think that most of it, like in 2022, it was probably mostly Prospect, and in 2023, it was mostly Steward. And to be honest, like so actually, you know what? Let me answer this question within the framework of our first point about like the human cost and the doing the morality of this and like doing right and wrong. Okay, so like now the company is like coming up with this narrative about how like they did everything they could to support their struggling tenants. Why didn't you cut the rent? Like if you wanted to support instead of loaning them money or hiding rent deferrals, just cut the rent. I know why. I know why. Because if you cut the rent, your earnings would have dropped. But if you loan the money to keep paying you rent, you get to keep booking your earnings and earning your comp and telling the story to the street. So, like, don't tell me you did this out of the good of your heart. Like, no, you did this to deceive people deliberately. And like, I and Hedgeye, and by the way, no one should stand for that. Like if we're going to accept stuff like that, and by the way, like just to be clear, if you send money to your tenant to pay you back rent, there's a word for that. It's called a Ponzi scheme.
Yep.
And like that is actually what it is. And my view is that like myself and others in the public markets have a responsibility to find this stuff so that innocent people don't get taken advantage of because it's predatory. And in the background, the hospital systems, getting back to the first point, are struggling and in many cases, like almost dying under the weight of these unaffordable leases that shouldn't be there if you really cared about like, deliver like having those entities be able to deliver care. Like we're not talking about a portfolio of Applebee's or Olive Gardens here that are triple net. Like these are hospitals. Like
They're
this is
hospitals and they go away. There's no one's going to
yes,
backfill that. I mean, that's it. So there is a community that now has to drive two towns
yes,
over to get
right.
care. There are lives that are at risk.
This is real stuff here. Like these are hospitals in many cases. Like if you there was one that closed. I think it was last March, or maybe it was either March or April of 2023, called Texas Vista, which is owned by MPW and was leased to Steward. It closed just outside of San Antonio. A hospital like that might be the only health option for like six or seven surrounding towns. And it closed because Steward was in the process of running out of money, but also like no other operator was willing to come in and assume the rent that MPT was charging or MPW was charging. So like I am aside from the financial, there are plenty of financial reasons or like numbers reasons why this doesn't make sense. And like I think the stock's a zero. But like this is a this is like a sociopathic exercise of extracting value out of a safety net hospital system that might be the only healthcare option for miles. It's nuts. And oh, and then by the way, like let's not forget, you know, like a bunch of knuckleheads like showing off their wealth with the private jets and the hangar
Of
and like
course.
yeah, and the the Steward CEO who bought a yacht. By the way, that's a funny story. Actually, I should tell that. No, actually, it's not a funny story, but it's one of my finds, I guess. Like sometimes the visuals help a lot, right? So like one night in September of 2022, I was just like again, it was Friday. My wife went to bed, my kids went to bed, and like when you have that feeling where your hairs are standing up in the back of your neck and you're just like I can't put my hand on it, but like I know something's wrong. I just Googled Ralph Delatorre is the CEO of Steward and Yacht.
I just Googled it, took a
Just Google
shot.
it. And lo and behold comes back the 190-foot Amaral that was acquired for $40 million
Oh,
in May of 2021. By the way, a couple of months after about $111 million of cash was dividended out of Steward.
oh,
And I called up Dan Holland, who runs our studio team, and I'm like, Dan, you're never gonna guess what I found. And he's like, let me see it. And Dan's a media guy, so he's like a very visual person. And I sent it to him on Monday. I came in, he came up to me, he's like, this is a fraud. And I was like, what do you mean? He goes, listen, like there's no way that a former cardio like a cardiologist who runs a safety net hospital system should have a billionaire toy. Like this is a fraud. Like he goes, like, I don't know how it's a fraud. I have no idea. Like you figure out how it's a fraud, but like this is a fraud because that shouldn't be.
yep.
Like it was like a visual example. And now juxtapose that with the suffering that we're reading about in Massachusetts right now. That's like all over the globe, all over the Boston Globe, and like politicians are dealing with, and nurses and doctors are having to put medical supplies on their corporate on their personal credit cards, or bring in their own medical instruments to do surgeries because Steward can't afford to pay their vendors and get supplies. And like it's nuts. It is an absolute disgusting disgrace. And like people say to me all the time, like, what's it feel like to have found this? I gotta tell you, it feels bad. Like because it's not a happy tale. It's really not. It's not a happy story.
You said no one should stand for this, and you think the stock is a zero. You went through the process, you stood your ground, you put out the research. The stock is not a zero, it's down, but it's not a zero. People are standing for it, at least to some degree. Some people are.
Yeah, yeah, it's fair.
What do you make of that? I mean, you put this stuff out there and you think like, okay, the investing world is gonna
Yep.
react to it, and to some extent they do. There's a lot of chatter, a lot of noise, but a lot of people just seem unaware or oblivious, or that they do stand for it, they do accept it. What do you make of that?
Yeah, well, I mean, that's a good question. I think one thing that I've learned is like, first of all, things take time and space. And um, look, if I'm right, and there's just to put some numbers around it, they have about call it like a little over $10 billion of debt on their balance sheet, and I think their assets are worth like a little less than seven. So like if I'm right about that, it's a zero. The question is like, how does it get there? And the company that no doubt wants to continue its life is going to fight back and like try to find ways out of the box. Like I don't think there's an escape hatch in the long run. So there's a question as to like what path it takes to get there. But yeah, I mean, I think like, well, first of all, the analysts are coming, or at least my compatriots on the sell side I think have kind of come around to it. You can observe like a more a critical line of questioning, and several have sells on the stock, et cetera. Right now, the answer to your question may be that it's like a credit exercise. So in my view, um, and I'm constantly learning about this on the fly, on the so by the way, taking a step back, like there are a bunch of different markets that this company touches. There are the equity markets, which is the stock, but then there are also the fixed income markets and the credit markets. It's a huge unsecured bond issuer, right? So it has $7 billion of bonds outstanding and $3 billion of bank debt. And I think what is happening here, and I've had to learn this too, the credit analysts in many cases are taking MPW and putting it in this framework that they use to analyze all REITs. But what they're missing is that like MPW actually or effectively isn't a REIT. It's an investor in the ops, in the operations, right? Because like if you think about what they're doing, like if I strike a rent that is more than 100% of their profitability or their ability to pay the rent, but then I invest loans and equity in the OpCo, I've basically invested in the whole system. I'm pulling out 100% of the economics of the system.
Right.
And so really what this isn't a real estate loan vehicle at all, by and large. This is actually like almost like a carving up or securitization of OpCo cash flows hiding in what purports to be a REIT. And so what I think people are doing is they're looking at the balance sheet and they're saying, okay, I see $14 billion of capitalized real estate on the balance sheet. But they're failing to recognize that like again, back to the comp plan incentives, MPW massively overpaid for it. And a good portion of that value just may not be there.
Yeah. And you've written that you think MPW should lose its REIT status.
No, I don't know if they should. I think that it's a question that needs to be asked. That, by the way, I don't think we've ever had to ask that question before. It's actually it's in a way it's kind of like an academic exercise, but it's a very like pertinent, critical question for this company. And what I mean by that is, so again, there are limitations under REIT rules on what percentage of non-real estate companies you can own, right? So for example, you can't own more than 9.9% as a healthcare REIT of an operator directly. You can't own more than 35% of an OpCo via what's called a taxable REIT subsidiary. It's just a structuring thing without getting too complicated. Otherwise, you're outside of your REIT rules. Well, in this case, just in the case of Steward, right? If Steward goes bankrupt, and in my view, that's an inevitability, MPW is a 9.9% equity holder and the largest unsecured creditor outside of the trade payables of Steward. So if they go bankrupt and they're the new equity, they own the operator, right? So like immediately, without a cure, they're outside of REIT rules. And I think that like the questions need to be asked, like, A, how are they allowed to do this in general? But B, like, what does that mean if that happens? Like that's a disaster. That's a complete travesty.
Right. Right. So where do things sit today?
Well, right now we're kind of, well, that's a really good question. Where do they sit today? So yeah, that's a really good complicated question. So as we sit here right now, MPW basically has a fully drawn revolver, more or less, on my numbers. They are short. They have about $400 million of liquidity, which may sound like a lot, but it's actually not, given that like the revolver is basically fully drawn, and they have a $300 million debt maturity in 2 months, another 100 million coming due in December, but then 1.4 billion coming due next first quarter. So as we
1.4
stand here,
billion in early 25.
yeah, the first quarter of 25. So over the next year, you're talking about 1.8 billion of maturities. Um, so like, and if you think about what that means, if you have basically like no availability under your revolver, if you're burning cash, which they are, your largest tenant may file for Chapter 11 and your second largest already failed. And I could literally go through another like 20% of your rent that can't be afforded by the operator. My question would be how how do you solve that, right? Like what they're saying is, oh, we're gonna sell assets and we're going to, maybe do some secured debt. What I would say is, what are you waiting for? That's a good question because like you're on the clock. Two, what are your banks going to say about that, right? Because like they're no doubt worried, and are they going to require like a cash sweep mechanism, mandatory pay downs, dividend restrictions, like all these things? But then also like assuming they are able to actually sell assets to just get to 25, one of the issues here is that the quality falls off very quickly, right? So like if they sell what they can, it's adverse selection. If you sell what you can to kick the can, the real question is what's left on the other side of that.
Mhm.
And how fast does it accelerate downwards after you buy time? And my view is like maybe they have one or two Hail Marys left, but like what's left on the other side is just outright scary.
Yeah.
And that's where that may be the answer to your question, like why is it not a zero? Because there's a little uncertainty as to like how that path, well, like what path it takes, you know?
Yep. Yep. It's a hell of a story, and we're going to watch it pretty closely. I want to thank you for coming on.
Oh
For
yeah, man.
standing
Anytime.
tall, standing behind your work and your research. It's cool to see real due diligence still being done. With beyond just, well, we're just going to market cap weight it. So
I
the
appreciate
market
that, man.
market doesn't exist without it. Without people like you, without people on rooftops, without people digging in,
Well,
doing
everybody at
forensic
Hedgeye, by the
work.
way, outside of REITs as well. Like we're trying to do, we're not trying to find problems, but like when we find them, my colleagues and I, we very like unapologetically talk about them because we just think the world needs it. So
The world needs it. There's a lot of people that would just rather get along and not make waves and let things be. And that's how you get to the golden age of fraud, right?
yep,
That's how it happens. That
Jim
and a
Chanos,
complacent,
great line.
yep, and a complacent investing public that just doesn't care. They're happy enough that every basis point on the fee they care very much about, but when they are investing in their index funds in stuff that is clearly frauds, and let me tell you, it's not just this one. There are more frauds that we don't yet know are
Oh yeah,
frauds in the
for sure.
S&P. It becomes an issue. So anyway, thank you for coming on. Where can people find more of your work, of
Yeah.
Hedgeye?
Yeah, so well, my company's website's just hedgeye.com. We're primarily a macroeconomic research shop. And we do like individual sector research, of which I'm the REIT guy, for better for worse. So you can go on there and find all of us. But then we're very active on Twitter, so it's at Hedgeye, or in my case at Hedgeye REITs. And you could honestly, you could probably go on there and find all you need to know about this company. Maybe get a laugh out of it too along the way. So not making light of the horrible situation, but like I think that these guys are a bunch of clowns, and they resort to intimidation, and like if they want to act like clowns, I'm going to treat them that way, and like hopefully do some good along the way.
Well, the cartoons are fantastic as well. There
Oh,
are there are some
there are
laughs.
more coming. Stay tuned.
There are some laughs along the way, and we need that.
Oh yeah.
So appreciate that. Thank you to the audience for your time and attention. We'll be back.
Thanks, Phil.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.